Okay, make sure you sign in. I got to drop all these people. I can't have class. I don't have a class where people just start showing up the day of the exam, because then I got to hand out all kinds of D's, and I don't do that. So if you know somebody, you might tell them, influence them to show up to class, because this ain't happening. This is not happening. Accounting is a subject in which you show up. You show up, you do it. Accounting is not like economics, where you sit there and read the book and they say, oh, supply equals demand, and then you can get, okay, supply equals demand. I don't know what that means, but I'm going to go ahead and remember supply equals demand. Accounting doesn't work that way. Accounting is like working out. Accounting is like if you want to have this over here bigger because you want to walk around like this and have it bigger, then you got to do this until it gets bigger. That's accounting. There is no, you want to play the piano? You want to play Mary Had a Little Lamb? You show up and you learn how to play Mary Had a Little Lamb. There is no, I'll catch up, I'm not going to pay attention, I'm not going to show up to class, and somehow, all of a sudden, I'm going to walk in on the day of the exam and it's all going to come together for me. That's not the subject. That's not the discipline. Okay? As I said before, this is a discipline in which you learn by doing, then you do it again, and you do it again, and you do it again until after a while, and at some point, I'll turn around and I'll look at it and I'll say, when did you guys become accountants? Because you do it enough times, suddenly you're like, I got this, I can do this. Okay? But not coming to class is a disaster. Okay? All right, so we're gonna go ahead and get started. And as I had said earlier, this really, to many respects, begins the class. I mean, we need to understand something about the standard setters, FASB, and how it kind of fits into the whole model of business and all that. But this is a procedural class. This is a procedural class in which we're going to have to learn how to look at a business transaction, read what that business transaction is saying to us, and then record that business transaction into our accounting records. That is a mechanical, physical, probably better word, physical process. Okay, now, what I'm going to show you today is sort of the manual way of doing it. Probably next time, if not tonight, but more likely next time, I will show you that we have automated some of this. I'm going to only make you do the manual process one time with me together in class. That's why I'm getting a little steam that people aren't here, because they're going to miss what is essentially the whole foundation for everything that we're going to be doing in our practice quizzes, for our quizzes for each chapter, our practice midterms, whatever, and then our actual midterm. We will not have to repeat that physical process, but I want you to have gone through it once so then you can see how different questions on the quizzes and stuff are answered. Okay? So, we're going to go through that process. I'm going to show you Chapter 2. We're going to spend some time with the slides. Most of the time is going to be with this chapter into Chapter 2 in-class example. Okay, and you're going to pretty much be watching what I'm doing as I go through that chapter into class example. However, I do have a marked up version of it so that you can see all the markings that I'm going to be making, and I'm also recording it so you can see that. And then, of course, the lectures are here. I'll post this particular lecture a little bit later, and then I'm thinking probably next time we will get to the quiz. Okay, but these documents are key. This in-class example, the marked up version of it, and then the clean version of it is a version where you would go in and you would fill everything in, and all I'm going to do is list the transactions. So we'll see that here coming up in a couple of minutes. Okay, but right now let's just go ahead. And let's take a look. Okay, class has started, guys. There is no continuing conversation that goes on indefinitely throughout the class while I'm trying to teach the class, okay? Okay, so what we're going to learn about is the double entry accounting system. Double entry means that for every transaction there will be a debit and a credit. The debit and the credit will always equal out. Debits equal credits. For every transaction, there will be a debit and a credit. The debit will always equal the credit. Okay, if we record an accounting transaction and our debit doesn't equal our credit, what does that mean? It means we're out of balance. It means we made a mistake. It means we need to fix that. Okay, so debits will always equal credits. Debits always equal credits. If you debit something, you have to credit something for an equal amount. Okay, so debits always equal credits. What is this? It's playing the narrations. So I got to take it off of that. Okay? All right. Debits must equal credits. Okay? And this is the way it works around the world. And this system, as I mentioned last time, has been around since the 12th century. Okay, this has been around since the 12th century. They say that Pacioli invented it. They call him the father of accounting sometimes. He was a Catholic priest, is the reason they like to call him the father of accounting. He didn't invent it. He just wrote about it in his journals. And so when we look back in history, we say, well, that's around the first time that people started talking about this double entry accounting system in which business, mostly men in those days, were using to record business transactions in 12th century Venice. Venice was its own republic at one point in time and had a lot of commerce going on. And so he's writing about a lot of things that were going on in Venice at that time. And one of the things he wrote about is accounting, okay, double entry accounting. Okay, now, this slide is, and the reason I'm flipping out that people aren't here, as you see what it says on this slide, if you do not know this slide, you will not pass this class. Anybody else not signed in? If you don't know this slide, you will not pass this class. If you do not know this slide, you will not pass this class. If you don't know this slide, you will not pass this class. Okay? And sometimes students say to me, well, how do you memorize that? You got to feel it. It starts to become something. I'll give you a little more room, sir. It starts to becoming something that you have to feel. Okay? So you kind of memorize it first, but then you have to feel it. Okay? So we know that assets equal liabilities plus stockholders' equity, don't we? Assets equal liabilities plus stockholders' equity. Okay? And we know that stockholders' equity is what two accounts? Stockholders' equity is made up of what two accounts? Huh? Good. Common stock and retained earnings. Don't start that because we have a balance sheet and we have an income statement. The what? Balance sheet balances, doesn't it? Because assets equal liabilities plus stockholders' equity. Stockholders' equity is what? Retained earnings and common stock. On our income statement, we report net income. Net income is what? Revenue minus expenses. So what do we put on the income statement? Net income is calculated how? Huh? Revenue minus expenses. So what do we put on the income statement? Why do they call it an income statement? They call it an income statement because they put pictures of dogs and cats on it. Why do they call it an income statement? Because we're going to report net income on the income statement, right? Okay. How do you calculate net income? Revenue minus expenses. So what shows up on the income statement? Revenue and expenses. You do not get to where you need to be in this class by looking at this stuff on Thursday night at 7 o'clock and then, going, oh, none of that ever happened. I'm going to pretend like none of that ever happened. You got to look back periodically, go back through the slides. I don't give you a lot of homework or anything, but you got to go back and look at things, right? Okay, so we have a balance sheet, assets equal liabilities plus stockholders' equity. We have an income statement, revenue minus expenses, right? Now, stockholders' equity, somebody said correctly, is common stock and retained earnings. What goes into our retained earnings? Okay, well, that answer was too much. It's our piggy bank in which we have what? A beginning balance. We take our net income from the income statement. We don't report the revenue and expenses there because that's on the income statement. We take net income from the income statement and report it into our add to retained earnings, right? And then we subtract the dividends. That gives us the ending balance. BASE, right? Okay? Okay, good. Now, debits and credits can be either plus signs or minus signs depending on whether we're talking about an asset, a liability, a stockholder's equity, a revenue, an expense, or a dividend, even though dividend doesn't show on this slide. Okay, it can either be a plus sign or a minus sign depending on whether we're talking about asset, liability, stockholders' equity, revenue, expense. It can either be a plus sign or a minus sign. Now, if I want to increase an asset, if I want it to, if the debit's going to be a plus sign, if I want to increase an asset, I have to debit it. If I want to decrease an asset, I have to credit it. If I'm going to increase a liability, I have to credit it. If I want to decrease it, I have to debit it. If I want to increase my stockholders' equity, I have to credit it. If I want to decrease it, I'm going to debit it. Okay, now when we talk about stockholders' equity, that's common stock and retained earnings, right? So let's get a little more deep than stockholders' equity here. If I want to increase my common stock, I have to do what then? Credit it, because to increase stockholders' equity, you credit it, right? If I want to decrease my common stock, I have to debit it, right? So the two accounts that constitute stockholders' equity have what? Have move in the same direction of stockholders' equity, don't they? Okay. Let's talk about revenues and expenses. So when I have revenue and my revenue goes up, should my net income go up or down? My revenue causes my retained earnings to go up, doesn't it? So my retained earnings is a part of my stockholders' equity, right? Right? So to increase my retained earnings, I would have to credit it, wouldn't I? Okay, so revenue is a credit because ultimately, although we put it on the income statement, revenue will do what? Will increase my retained earnings, won't it? So revenue moves in the same direction as this stockholders' equity because it moves in the same direction as retained earnings. If my expenses go up, does my net income come up or down? My expenses go up, my net income does what? Comes down, and then what? My retained earnings will come down? My net income comes down? And so if I want to what? Increase my expenses, I debit them. That debit will ultimately do what? Be like a debit to retained earnings, which to decrease the retained earnings, I would debit it, wouldn't I? Now, this slide is not showing us dividends, but do dividends increase or decrease my retained earnings? Decrease. Good. Dividends decrease my retained earnings. Dividends, therefore, kind of act like expenses, don't they? So if I debit my dividend, that increases my dividend. If I credit it, that decreases it, right? Okay. So if I'm debiting my dividend, that ultimately is going to decrease my stockholders' equity, decrease my retained earnings. Good. Now, I don't, you say, well, then why don't you just call it an expense? Why don't you just call it dividend expense? Because it's not an expense, it's a dividend. Remember I told you there are sometimes you'll say, well, why don't they just call it expense? And my answer to you is going to be because it's a dividend. It comes right out of retained earnings, right? Remember we pulled the little plug out of the piggy bank's butt and we took the dividends out? Okay, so we don't report it as expense, we call it dividend. Okay, all right, now let's just use an example. Let's say I issued common stock for cash. I issue common stock for cash. If I issue common stock for cash, is my cash going to increase? Yes. Okay, so I guess I better do what? I guess I better debit cash. What did I say for, did I say how much? 100,000, whatever. Right? Do debits have to equal credits? So I know I have to credit something else for 100,000, don't I? Okay, so what's going to happen? Well, if I issue common stock, is my stockholders' equity going up? No. On what planet? If I issue common stock, is my stockholders' equity going up? Yes. There are two accounts that constitute stockholders' equity. One is retained earnings, one is common stock. When I issue common stock, I have to increase the common stock. Remember that exercise where we went through and Neil and Barbara Bush, or whatever their name was, started up soft bite, and when they issued the stock, the common stock came up, didn't it? So we show that, hey, somebody owns this cash. They're the stockholders outside of the company. So if I issue my common stock, does my common stock have to go up? Does my common stock have to go up? Is common stock a stockholders' equity account? Yes. How do you increase stockholders' equity? You credit it. So my debits equal my credits, and I have now done what? I have now credited my common stock, haven't I? Do my debits equal my credits? Does my balance sheet balance? Can I prepare a balance sheet now? What appears on the balance sheet? Asset equal liabilities plus stockholders' equity. Do I have any assets? Yes. What? Cash. Cash is an asset. Assets have future economic benefit. Cash is your favorite asset because you can turn it into any future economic benefit you'd like, right? Okay. Okay, good. Do I have any liabilities? What liability? Common stock is not a freaking liability. Common stock is stockholders' equity. Stockholders' equity is constituted of two accounts, common stock and retained earnings. Is common stock a liability? No. My liabilities are my bills, aren't they? Stockholders' equity, what people invest in this company and take stock back for, is not a liability. What happens if I lose all their money? What happens if I lose all these people's money? They just gave me 100,000. What happens? No. They go and they cry somewhere. Sorry, you gave me the money. You're fool enough to give me the money. I don't owe it back to you. This is you walked up, not you, our imaginary person, walked up and said, hey, man, I really like your business proposition. I always was planning to do something like that. Here's 100,000, man. Make it happen. And I sit there and I go, oh, yeah, man, this thing's really going to take off. And it turns out that what I've invented is, something to pick your nose with that's about this big. Wait a minute. I can't get that. Maybe if I smell the other end, and it causes brain damage. So what happens? Obviously, I'm making it up as I go along. So what happens? You sit there, and can you believe that? And stupid invent. Why did I invest in that? You ain't getting no money back. It's gone. Okay? So that's not a liability. Now, if you loan me the money, if you say, hey, here's 100,000, John, but I want written up in a contract that you're going to give me the money back if this, that, and the other happens or whatever. You write somehow it meets the definition of a contract that constitutes a liability, and I lose the 100,000. Then what are you going to do? Huh? Seize your assets. What assets? I spent the 100,000. Maybe you've done something to pierce the corporate veil, whatever, but you got a date with Judge Judy, don't you? You ever seen a situation when people give money and then they were supposed to do something and they don't do it? Judge Judy is none too happy. She says, you're going to pay this person today, doesn't she? Okay? All right, so what happens? That's a liability. Our bills are liabilities. Common stock is stockholders' equity. So we've got $100,000 in stockholders' equity, don't we? It works. It's magic. They probably put the guy who invented this in the cell next to Galileo. This cannot be. This is magic. Did my debits equal my credits? Did my debits equal my credits? Did I follow the rule to increase an asset, you debit it, to increase stockholders' equity, you credit it? Did I follow that rule? And I was able to prepare a financial statement, a balance sheet, wasn't I? Okay, good. Now let's say that I decide to buy some equipment. So I pay $40,000 for some equipment. Okay, if I pay $40,000 for equipment, did my cash go down? Yes. So cash, I want it to go down. I spent what, $40,000? To decrease cash, I should do what? Credit it for $40,000. Good. What did I buy? I bought equipment. If I bought equipment, should my equipment account go up? Yes. Is equipment an asset? Yes. So to increase it, I should do what? Debit equipment for $40,000, right? Right? Okay. Can I prepare my balance sheet? Okay. So I have equipment now of how much? I have equipment of $40,000, and my cash went from $100,000 to $60,000. Good. Does my balance sheet balance? Did you see any rabbits jump out of any hats? There was no magic up here. I simply did what? I made sure my debits equal my credits, and I followed the rules that you have to know on this slide, which is to do what? To increase an asset, you debit it. To decrease it, you credit it. Is that what I did? I decreased the asset cash by crediting it. I increased the asset equipment by debiting it, right? Okay, good. Let's say I provide some service, and somebody gives me $10,000 cash for that service. If someone gives me $10,000 cash for my service, did my cash increase? Yes. So I'm going to sit there. Cash, I'm going to do what? Debit cash. What did I say, 10,000? Okay, I have to credit something, don't I? If I do work, have I generated revenue? If I do work, I've generated revenue, so I want my revenue to increase, don't I? So my revenue should be what? Credited. So I credit revenue for $10,000. Right? Now, my cash is now $70,000, isn't it? And my balance sheet feels a little woozy. My balance sheet's going, you know, I don't feel in balance. Wait a minute. What'd you put in my drink? Okay, so what's going to happen? Well, I'm going to have to prepare my piggy bank. Put the tail, or otherwise it's not a pig, right? Prepare my piggy bank, and my beginning balance in my retained earnings is 0. On my what? Income statement, IS is income statement, I'll have revenue of 10,000. Right now I have expenses of what? 0. And so revenue minus expenses is what? Revenue minus expenses is called what? Net income. net income. I add my net income to my retained earnings, don't I? Don't I add net income to retained earnings? So my retained earnings now has an add of 10,000. I haven't paid any dividends. I would subtract dividend. I haven't paid any, so that's 0. What's the ending balance in retained earnings? Huh? Ending balance in retained earnings is 10,000. Okay, ending balance in retained earnings is 10,000. So when I prepare my balance sheet now I'm going to report retained earnings of 10,000, right? Because that's part of my stockholders' equity. Does my balance sheet balance? Did my balance sheet balance? Did any rabbits jump out of any hats? No, they did not. I simply followed the system of making sure that my debits equal my credits. I followed the system of what? To increase an asset, I debited. To increase a revenue, I credited it, didn't I? Let's say I pay an employee $3,000. In fact, let's say I don't pay them cash. Let's say I tell them I'll pay you at the end of the week. They do some work for me. I tell them I'll catch you at the end of the week. Do I have a bill? I have salaries pay a bill, don't I? Okay. So if I have an employee do some work and there's no future economic benefit associated with that work, it has expired. Okay. We're going to have to keep awake. We're taking notes. We're being asked to take notes. We're being asked to take notes that'll help other people. Then we need to stay awake, right? Okay. So what happens? You sit here and you have your expenses. Have my expenses increased? Okay, the future economic benefit is expired. The expenses have increased. So I'm going to go ahead and do what? Debit expense? Okay, for how much did I say? No, I'm not paying him 10,000. 3,000? I don't know, whatever. Okay. Good. Since I'm going to pay them later, I'm going to have what? I'm going to have a credit to salary pay a bill. It's a bill. Huh? Yeah, salaries pay a bill is a liability because I'm going to pay them later, right? Okay. So to increase my liability, do I credit it? To increase the liability? To increase the liability, do I credit it? We're just following the rules here, aren't we? Debits equal credits. To increase the liability, I'm telling you the salaries pay a bill is a liability. These damn glasses. So I'm going to credit it, right? Okay. So I credit it for 3,000. Okay, good. Now, have my expenses increased? Have my expenses increased? Debit expense 3,000. I increased my expenses because they did the work, didn't they? Okay, so my expenses are now how much? 3,000. As a result, my net income has decreased, hasn't it? If my net income decreases, then my retained earnings decreases, doesn't it? So the ending balance in my retained earnings is no longer 10,000. It is now what? 7,000. And now I have a liability. I just told you the expense. The expense? Okay, everybody. How do you calculate? What's reported on the income statement? Everybody. No, net income is on the income statement. That's why they call it an income statement, because it doesn't have pictures of dogs and cats on it. It has the net income on it. They call it net income. They call it income statement because it has net income on it, doesn't it? How do you calculate net income? Revenue minus expenses. So what's on the income statement? No, revenues and expenses to equal net income. Right? That's the income statement. Okay? What's on the balance sheet? Assets equal liabilities plus stockholders' equity. That's why they call it a balance sheet, because it balances. So do I have to put something on the balance sheet now? This salary's payable, don't I? Okay, good. So now I have salary payable of $3,000. Do my assets equal my liabilities plus my stockholders' equity? Let's see, 107,000. Yeah, 110,000, right? Stockholders' equity, salaries payable is a liability, isn't it? Assets equal liabilities plus stockholders' equity, doesn't it? Assets are what? 110. Let's add them up. Assets are 110,000. My liabilities plus my stockholders' equity is how much? 110,000. 110,000. Does my balance sheet balance? Did any rabbits jump out any hats? You may say, well, no rabbits jumped out any hats, but you did perform magic, right? No. There's no magic going on up here. We do what? We make sure our debits equal our credits. We do what? We follow the rule to increase an asset U. To increase an asset U. Debit it to decrease an asset U. Credit it to increase a liability U. To increase a liability U. Credit it to decrease it U. Debit it to increase stockholders' equity U. Credit it to decrease it U. Debit it to increase revenue. Since revenue increases retained earnings, revenue is part of my retained earnings is part of my stockholders' equity. I increase my revenue by crediting it. To decrease it, I would debit it. I increase my expenses by debiting them. That'll decrease my net income. If my net income decreases, if my expenses go up, my net income is decreased. If my net income is decreased, my retained earnings, my stockholders' equity is decreased, right? No magic going on here. Okay, good. Now, let's do it again. To increase an asset, you debit it. To decrease it, you credit it. To increase a liability, you credit it. To increase a liability. To decrease it, you debit it. To increase the stockholders' equity, you credit it. To decrease it, you debit it. Good. To increase revenue, you credit it. To decrease it, you debit it. To increase expense, you debit it. Good. To decrease it, you credit it. Dividends reduce retained earnings just like expenses do, don't they? So even though this slide isn't showing you dividend, we can figure that out. To what? Increase a dividend acts just like an expense. You do what? To increase dividend, you debit it. To decrease it, you credit it, right? Hello? Right? Now, sometimes students will say to me, how do you memorize that? It's not memorized. It is the last thing that I will forget. I'll be sitting on a park bench somewhere feeding the squirrels, whatever, and they'll say, oh, what's your name, sir? And I'll go, huh? They'll say, what's your name, sir? And I'll say, huh? My dad was a Marine. So when we go out in the winter and he's, needs a hat or something, I'm like, Dad, get your hat. So he got a Marine hat. So he wears his Marine hat. And he goes out and some lady comes up and says, thank you for your service. My dad goes, huh? What? What service? My dad wanted out of the Marines. So all he wanted was out of there. Okay, so anyway, he never made it to Korea. He's like, there's like this Marine thing, Semperfi. You ever heard of this? It means always faithful or forever faithful or something like that. Huh? Always faithful. Okay, so So I was at a sushi restaurant, and they called it the Simplify roll. So I asked the guy, what's Simplify? And the guy said, well, that's the Marine motto or saying or whatever, right? So when I go home, I said to my dad, how come you never told me what Simplify meant? You were a Marine. Oh, that was for gung-ho guys. I don't know. I never paid attention to that. Okay. All right. So anyway. So I'll be sitting on the park bench, and someone will say, what's your name, sir? And I'll, huh? And I won't know what it is they're asking me. So I'll finally want to say something, right? So I'll go, to increase an asset, you debit it. To decrease it, you credit it. To increase the liability, you credit. To decrease it, you debit it. To increase stockholder equity, you credit. That will be the last thing I'll forget. So at some point, it becomes what? It's got to become part of your DNA, guys. You cannot sit here and think that somehow you can memorize this the night before and all that's going to come together to you. You got to, here's what you got to do. When you get on the bus, you get on a bus. You say, but I don't drive the bus. Go get on a bus, okay? A bus going anywhere, and sit there on that bus and wait for someone to sit next to you. And when that person sits next to you, go, to increase an asset, you debit it. To decrease it, you credit it. I promise you they'll move. That bus will be empty by the time you get to your destination, okay? All right? You come home tonight, and here comes your roommate wants to talk to you. Oh, man, I don't feel like talking to this person. They'll say, guess what happened today? I was in. Wait a minute. Before you go, I want to say something. To increase an asset, you debit it. To decrease it, you credit it. They'll go, okay, I'm going to bed now. Okay? But every chance you get, you're looking at this thing and you are making sure that this is reactionary. This got to become reflex for you. And it takes a while. It takes a while. Okay? It doesn't happen overnight, but you got to put in, that's what I'm talking about, that physical process. You've got to sit there. You want your to increase an asset muscle to show, then you're going to have to work it, right? Okay? Okay, good. Good work, guys. All right. Now, this slide is helpful in that it does what? It shows you now each account, and it also finally includes the dividends and shows how to increase them, how to decrease them. Okay. Again, I had a student one time when I taught the CPA exam for almost 20 years, if not more than 20, before I started teaching introductory to accounting. So when I teach the CPA exam, everybody knows this already, right? So I had a student say to me, what's a debit? And I was like, wait a minute, I don't have that teaching chop. I never had to teach that before. So I said, if we were making clothes, debits would be thread. I'm like, okay, no, that was not a good answer, right? So it only took me about 5 years until I figured out that a good answer to that is a debit is a plus sign or a minus sign, depending on what? On which account we're talking about, right? A debit is a plus sign for an asset. It's a minus sign for a liability, isn't it? Now, I had some students that say, well, why don't they just say plus and minus then? Because how will we keep everything in balance if we try to do that? We just say, hey, minus liabilities and what? Minus asset at the same time, if we had such a transaction. They're both minuses. How do we make sure everything's in balance? If we use what? If we use debit and credit, then we can make sure our debits equal our credit, and that system allows us to keep everything in balance, right? Okay? Anyway, so when I told the student that that's the reason, she said, oh, in other words, if it ain't broke, don't fix it? And I said, no, it is thriving, so don't fix it. It has worked since the 12th century, so don't fix it. There is an entire economy that is being kept track of this way. Okay? All right, good. Question? Okay, so our job is to analyze a transaction. Is it affecting asset? Is it affecting liability? Is it affecting revenue? You don't need a magnifying glass to do that, by the way. Okay, you'll look at the transaction. You'll simply say, hey, is it involving a revenue? Is it involving an asset, etc.? Then you will enter the transaction into a journal. You enter the transaction into a journal, and then you will post, is the correct word, not transfer. You will post from the journal to the general ledger, and then from the general ledger, we will pull our financial statements. Our financial statements are what? What are our financial statements? Balance sheet, income statement, statement of retained earnings for now, okay? Okay? Okay, good. Now, what we're going to do is go through this transaction, this example, in class example. You know what? We're going to do something a little different. We're going to take the break early. I know that probably messes up some of your game plan. I want to take the break early because what I want to do is give you guys a handout of this example. I think it's better if you have the example printed in front of you and you can sit there and mark it up as we go. And so I'm going to call an audible, football term. I'm going to change the play right here. And I'm going to take the break now so I can go and quickly print up a bunch of these examples. And then make sure you sign in, okay? And then we'll hand them out. So let's reconvene, guys, in 15 minutes at 8:05. No, I'm going to start the break right now, and then I'll come back to the previous slide after I go print that. Because we got people that walked out, and then they're going to come back and think that, and meanwhile we talk about something else. So hang on. I will answer your question, sir, for sure, but not right this moment. Make sure you sign in, guys.